Africa risks missing the emerging market moment. I think the world risks missing the African opportunities. And I think as an exchange executive from Africa, it's time for the African exchanges to actually stand up and tackle those risks. So my story is one about possibility, about opportunity, and about brave choices. It's about the possibility that African capital markets have to be amongst the giants in the global environment. It's about the opportunity they have to harness emerging market appetite, to build really big, sustainable exchanges capable of attracting and absorbing significant international investment. But it's also about the fact that those capital markets are at a point of critical inflection. They need to decide, are they going to stand alone and compete for an increasing share of an investment dollar, or are they going to work together to build really large, sustainable exchanges that can, in fact, compete properly, that can, in fact, use this occasion to actually leapfrog exchange developments so that in a century's time we'll be able to not talk of the New York Stock Exchange, we'll be able to talk of the African exchanges as the preeminent exchanges in the world. So you may think of Africa as the source of the recent conflict as opposed to the cradle of mankind. You may think of Africa as a place rich in natural resources, as opposed to a place where there are some of the world's largest banks and telecommunications companies. You may think of Africa as a place to go on safari, as opposed to a continent that is larger than China, America, and India put together. You may think of Africa as a home of some of the world's richest marketplaces, as opposed to the home of the world's 20th largest exchange and one that recently has been voted as the world's best regulated exchange. But Africa, of course, is not homogeneous. It's a continent with 53 different countries and 24 different exchanges. And so it's clear from a map like that that many of these exchanges are extremely small. In fact, I can tell you that some of them have never traded. Some of them have traded once or twice a year. So why would we need 24 different exchanges? And the burden that exchanges bear is that they often are alike to national airlines. Everybody wants one. But like the fact that an airline needs fuel to operate, the fuel for exchanges are investors and issuers, people who actually want to transact in a marketplace. If it's too small, the rude reality is that you won't find business happening there. And if you want to encourage business to happen there, you actually have to build a marketplace with sufficient space to do that. So what actually stands to Africa's choices? Well, let me show you. In case we start to think about Africa and what it should do, the Johannesburg Stock Exchange is the largest exchange on the continent. 66% of Africa's market cap in the southern part of the continent. We end up with the Johannesburg Stock Exchange being about 10 times the size of Egypt. 10 times the size of Egypt, trading about 6 times Egypt's value every day. The JSE is about 60 times the size of the Kenyan exchange, trading about 300 times what Kenya trades every day. In fact, the JSE in a single trading day trades more than 6 other African exchanges put together. So you can see immediately the difficulty of African capital markets attracting significant enough investment for African capital markets to play a meaningful role in the development of the continent. And in case we think that that's very impressive for the JSE, it's important to put this in perspective. The JSE itself is a minnow in the context of the global markets. If you take the London Stock Exchange, which is in the same time zone as the JSE, the London Stock Exchange, 4 times the size of the JSE. It trades 5 times the value of the JSE every single day. And of course, the global behemoth is the New York Stock Exchange Euronext, and that shows them together. But if you just took the New York Stock Exchange, it on its own is 5 times bigger than London and trades between 7 and 10 times more in value a day than the London Stock Exchange. So clearly, African exchanges are going to have to fight very hard to get a space, any attention in the global investment landscape. So now, what should they do? Well, I think the first thing exchanges need to realize is that no one owes them a living. Exchanges only have a right to exist if they provide a service to the issuer and the investor. If they aren't providing a way to bring the issuer and the investor together, people will bypass an exchange. If they're going to provide that service, it had better be of an appropriate quality, not some emerging market quality, an appropriate quality, appropriate legislation, appropriate rules, places where you would feel comfortable. So let's look at the choices that these African capital markets face. The first would be the prospect of harmonizing the rules in those capital markets. So let's take as an example 3 marketplaces on the continent. Now let's assume that you were Rick from New Haven and you were looking to actually invest in the emerging markets. You'd heard that there was this amazing oil story in Uganda. So you phone up your broker and you say, I'd really like some oil stock in Uganda. Now, assuming your broker actually has managed to find Uganda on the map, then actually has to figure out, now, am I allowed to trade in Uganda? And what actually happens is that they have to go through a whole risk analysis of these countries. Then he'll figure out that Uganda doesn't have laws that look familiar, doesn't have trading systems that are electronic, doesn't settle every day. These things are critical for investors, as I'm sure our sponsors will know. So we end up in a situation where they say to Rick, no, I'm sorry, but I can't actually get you to Uganda. So Rick says, well, I mean, there's a coffee story in Kenya. And they'll go through the same issue. And then the broker may say, but have you heard about the banking story in Tanzania? And we'll go through the same issue. The point is the broker will go through 3 separate risk analyses to try and get companies that their clients want. Well, wouldn't it be easier if, in fact, we actually harmonized the rules in those areas? So then Rick from New Haven could say, I'd like to buy Kenyan coffee or Tanzanian bank. And the broker would say, well, hold on, I can get risk approval for this region. So that seems to be attractive to an an investor. If you're looking at an issuer's perspective, it's attractive to an issuer too. Why? Because he then can be easily accessed by an investor. And it's attractive to the exchanges because if they get more attention, there'll be more liquidity in the exchange. So what's the elephant in the room here? The elephant in the room here is if you happen to be the country whose rules are not taken as the harmonizing standard, is that a blemish on your reputation? Is that saying you're not good enough? It takes quite a lot of leadership to actually get to the point where you'll say, I'm prepared to harmonize to your standards. But lest we think that this is impossible, in fact, this is what happens in the European Union. These are what the European directives on harmonization say. So it's possible, but it takes leadership. Another potential model would be the whole question of cross-listing. Now let's take Rick from New Haven again. And Rick wants to invest in Namibia. And he finds company X to get to Namibia. But he talks to his broker, and the broker says, Namibia, I've got to get through my risk analysis, and that's a little bit tricky, I can't do that. So Rick says, well, hold on, then I know there's company Z in South Africa. South Africa, member of the World Federation of Exchanges, surely I can invest there. And the broker says, funny you should say that, I can in fact get you something in South Africa. But that only helps Rick to a limited extent. It gets Rick to company Z, but it doesn't get Rick to company X. So the possibility here is that we actually cross-list, and we allow both companies to be listed in both countries. So therefore Rick can buy X and Z in South Africa and Z and X in Namibia, depending on where Rick wants to go. Now, that's beneficial to the investor because they have the choice as to where to trade. It's beneficial to the issuer because they're seen in 2 different economies, and it's particularly beneficial to issuer X because now he can be cross-listed in a bigger marketplace. Now you might wonder, is this beneficial for the home exchange, the smaller exchange? And the answer is it's very beneficial. All the academic research shows that when you list a company dual listed in the home market and in a bigger market, the liquidity in the company increases. So what's the elephant in the room here? The elephant in the room here is that the smaller exchanges are worried that the larger exchanges benefit. But as I've said to you, that's not actually factually what happens. So let's look at some other models. Potentially the creation of an Africa hub. So we'll go back to Rick in New Haven. Now Rick is wanting to invest in both those countries, and what happens is that having got risk approval for both countries, the broker then has to connect technologically to both countries. This is expensive, it's time consuming, and the countries have to give the broker enough information so that the broker can actually trade. So if you had an Africa hub, what you would do instead is to create a technological single place of access. What you would do is you'd say to the broker, you know what, connect to the hub, and I'll enable you to execute in multiple venues. And that's essentially how a hub would work. Now, why is that interesting to an investor? It's interesting to an investor because they have one place to get all the information for 4 different exchanges in this example. One place to get all the information relative to any counter or issuer it wants in the region. Why is it interesting to the issuers? It's interesting to the issuers because they now get seen more simply by investors. Why would this be interesting to an exchange? Because all those exchanges that are connected into the hub have a way of getting their information to investors much more easily through a single channel. So what's the elephant in the room here? The elephant in the room here is that it requires exchanges to realize that they actually gain more from collaborating and putting their information into one hub rather than trying to reach all the same investors on their own. So who owns the hub? Who runs it? Why is it worth my while as an exchange actually paying to have my data in that hub rather than getting it to the investor myself? And then there is the whole question of creating a Pan-African stock exchange. So let's look at this region. This region, I've chosen again East Africa. You've got 3 different exchanges. As we've already discussed, 3 different exchanges, 3 different rules, 3 different management, 3 different sets of costs, all of which make getting in that region more complicated for investors, more complicated for issuers because they now need to meet many different types of standards. So if you created a Pan-African or Pan-regional exchange, what you would have to do is to collapse the then existing exchanges into a single regional exchange. Now, that regional exchange would be connected to each of the other countries and would enable investors to actually trade companies from each of those different countries. They would trade in one single place. But the obvious problem there is apparent, which is, so who owns that regional exchange? Where is it? What happens to my existing exchange? Do I then have to get rid of my people? Which rules apply? It focuses all the issues we've already discussed. This, of course, is utopia, not in Texas, but this is utopia, where one would, in fact, want to go if one had a clean slate. The reality is that we've now got 23 small exchanges. The chances of creating this without significant political leadership, I think, is very tricky. What is the benefit now for the issuers? The benefit for the issuer is you get seen in a single pool. The benefit for an investor, it's easy to know where to get, for instance, in this example, East African stock. The benefit for the exchanges, more difficult to see. But if they think in terms of the benefit that an exchange should produce for the regional economy, the benefit is clear. You have one place, much greater opportunity to encourage investment. So what do I think is going to happen? Harmonization, in my view, doesn't go far enough. It's been tried. It takes you only so far, and essentially, it's the least brave of the options. Pan-African or pan-regional exchanges would be where you'd want to go if you had a blank piece of paper. I think that's an unrealistic space to expect us to get to now, given that we have already existing exchanges. I think we should be looking at a combination of an Africa hub and cross-listing as a way to at least make change faster so that we can, in fact, accelerate the development of African capital markets, so that we can, in fact, focus on the fact that capital markets serve issuers and investors. They don't serve themselves. And if we manage to achieve those things, I think we will end up with really robust capital markets. So the message of the elephants is, if you're going to go it alone, will you be able to survive? If you have courage in the strength of the herd, the small and the big can coexist. I know where I'm going to put my energy. Thank you.